Welcome to our class on SAP product costing. Myself Rajan here. Should you need more details about our course and various other training programs that we have to offer for you and to help build your career, you can reach out to us on the given number and then the email ID. Should you have any doubts in product costing, you can reach out to me directly. My email at the bottom of the screen that you can see. Let's look at what we have for you today. As part of the SAP product costing training curriculum, we will be covering the entire gamut of SAP, what SAP has to offer, right from enterprise settings, then the integration of finance with material management, sales and distributions, production planning, controlling, what are the settings that is required for material ledger, for enabling the material ledger. We will be creating all the master data that is required for you. You can read all of these points. We will be covering in extensively, and then when it comes to product costing, we will deal with the various scenarios: what is preliminary costing, what is simultaneous costing, actual costing, product cost by order, product cost by period, by sale order, valuated, non-valuated, costing run, ML run, all of these. We also have a big list of various advanced scenarios that we will be covering, whether you need to make or buy a particular product, or whether you how much of proportion of raw materials that you should buy from different vendors or with different prices, whether you should import your raw material, or you can you make use of domestic raw material, if so in what proportion will give you the best yield. Similarly, if you have different processes to produce the same product, which process will give you the best efficiency and the best of the margin, how you deal with the cost splitting, production variance splitting, usage variances, how to deal with joint production, subcontracting, engineering to order, ABC costing, interplant transfer, intercompany transfer, then very complex subject. We also talk about transfer pricing, not in today's session. This is the entire course curriculum. Then we talk about profit center valuation, group valuation, material ledger, margin analysis, etc. And each of them will be covered in detail. Now, there is one thing we request you to note how we differentiate ourselves from the market. There's so many people who are good at subjects, SMEs. The In my career of 24 years, what I have seen is when I have come across various costing consultants, when I ask them, why do you do a standard price? Why do you do in SAP we have price determination and price control? What is the impact of this price determination of a standard price vis-a-vis map on your P&L, right? Where are your price differences parked, and what happens if you leave it there? People have not really understood what is the impact of it. They do are good in the way that configurations has to be performed, but why, how it impacts, etc. We are here to support you and help you really understand the nuances and nitty-gritties of SAP product costing. So let me not steal away a lot of your time. You can go back to the screen and you can look at each of these topics. There are one or two other topics which maybe I have not put it in here, but that will also be covered. These are not major topics, but each of these topics will be covered in detail. Now let me go to the next screen. What do we have for today? We have the first thing that we are going to cover is about what is product costing. In simple words, let me tell you what is cost. Product costing is costing of a product. Before a finished good or a semi-finished good is made, what are all the costs that goes into making that one unit of final product? Okay, let us look at the standard definitions. We have a definition here. Product costing is the process of calculating the comprehensive expenses associated with creating or acquiring a product, including direct costs like raw materials and labor, as well as indirect costs such as overhead and administrative expenses. I mean, quite a lot of theoretical stuff. Let me make it simple for you. I buy raw materials, and let's say I bought it at 100, whatever be the denomination, Indian rupee or US dollars or whatever might it be. So So I have bought some raw materials, right? Is my cost just going to be the pure price that I pay for raw material, or are there any other expenses that get accrued onto this raw material, right? As you can look at it, when I purchase raw material, not only the cost of material goes into the cost of that, there is also freight costs, insurance costs, loading costs, taxes, handling charges, customs and duties, and whole lot of other expenses that has to be loaded onto the raw material. And this 100, in our example, if 100 is the base cost of material and 30 is only of these expenses, then my cost of raw material that I show in the balance sheet is 100 plus 30 is 130. Now that my raw materials etc are in the warehouse, I start my production. When I start production, are there any other costs that gets accrued onto it? Of course, yes. The conversion cost, some call it activity cost, right? All those activities which I perform to convert the given raw materials into the finished product. I have given a small example here. Let's say I am into manufacturing leather products. Let's say I'm manufacturing a leather handbag. I get the skins. The first process is cleaning, and then probably the second process should have been cutting. Then the third process is stitching, and fourth process is labeling or fixing, and fifth process is final packing, etc. So in SAP we have this called work center. Work center is where a given set of activities are performed. So on your screen, if you look at here, we have Work Center 1, Work Center 2, and Work Center 3. Let me bring the um, laser pointer. Okay, here you go. So I have process 1 getting carried out in Work Center 1, process 2 getting carried out in Work Center 2, process N getting carried out in Work Center 3. So this whole set of operations that or processes and operations that a material undergoes before it becomes a finished product is called routing, is also referred as routing. Now, each of these work centers, you typically have a similar set of cost types. One is you definitely apply labor, then you apply machine costs, the cost of machine that you operate there, power, fuel, water, other expenses, whichever way you want to categorize. So, in a way, conversion cost deals with all activities that are directly involved in producing the particular product. Now, coming to once a good is produced, you also have the common costs like the rent of the administration building, the salaries that you pay for your accounting department, for your IT department, for your security personnel. So all of these common costs, which has to be allocated, you arrive at a percentage. Maybe you take the one way to do that is that you take the total or indirect costs and you charge it as a percentage and then load it to the finished product. In SAP, we have various techniques. One of them is you use a functionality called cost sheet. The other one that you can use is a template allocation. Using these techniques, you can load indirect costs onto your finished product. Then you arrive at your finished product. This is where you get your, here you arrive at your cost of goods manufactured. Fair enough. Not only this, even after you finish to market your product subsequent to the production, right, you do incur marketing costs, advertisement costs, freight over outward freight, transportation costs, insurance outwards, etc., dealer costs, or dealer training costs, salesman costs. All of these costs come subsequently. So those costs also, how do we arrive at? How do I come and calculate what is my margin generated at each stage? Is dealt by something called profitability analysis. We come to that in few slides from now. But I'm just giving you a sneak peek at this point of time. Fair enough. As of now, from this slide, you take that you what is product costing, how various different costs are loaded onto the material. Now I go to another way of the previous slide spoke about the entire production being carried out in-house in your own manufacturing setup. Now, I have dealt with clients, they are very, very top brands, right? But they do not even manufacture a single product. They procure raw materials, against they raise a production order, or they create a production order, and they issue raw materials, and then this entire materials goes to a subcontractor. Subcontractor converts it into the finished product. In fact, he even packs it, and he sends you the finished good, which is, ready to sale condition, and then you apply overheads, then you arrive at your cost of goods manufactured. Now this is a case where the entire operations, the conversion is being taken care by subcontracting. It can also happen that, let me go here. It can also happen that you may have the capability to do multiple processes, and then there could be a particular specific processes for which you may want to avail the subcontracting facility. So give an example: you are the manufacturer, you procure raw materials, and then you create your production order, you carry out the process one, and then subsequently you issue these materials to the subcontractor. Subcontractor carries out the process two, he converts it, then you receive the finished goods from against the production order. Then you apply the overheads, and then you get the finished product. Again, here you arrive at your cost of goods manufactured. Now, I have shown you three scenarios. These are not exhaustive scenarios. In the sessions, subsequent sessions, not today, but in subsequent sections, we'll also talk about how what is joint production, what is co-products, what is byproducts, and various other ways of production alternatives. Fair enough. Let's now go to the next slide. What do I have for you here? Yeah. How do these gets that these costs get accrued onto the finished product in SAP? Now, on the left of the screen, as you can see, these are the types of cost, and then what tools in SAP helps you load these costs. Okay. Now, I'm talking about make to order kind of scenario. You have a production order. Against this production order, you charge all the raw materials, semi-finished goods, packing material, etc. that gets issued in SAP. We use goods issue process, and then these costs gets loaded onto the production order associated with the finished product. Similarly, the conversion cost. Now, at this point of time, you get to know your actual labor cost, machine cost, power, utility, and all other costs over during the month. Or I call here accounting period as 1 month. Okay, typically a month or is an accounting period. You get to know about your actual costs at the end of the month. So until then, you do not know how much of labor have you consumed, how many hours of labor you have consumed, right? Let's assume it's an estimate, and then we have here conversion cost using activity confirmation. Using activity confirmation, I load on these costs against the finished product. How about the overheads, which we spoke about? We have a tool called cost sheet. Using cost sheet, we can load the indirect costs onto the product, the finished product. Fair enough. Okay. Now I'm taking a slight deviation and helping you understand what an MIS format. As you all are well aware, the financial statements, namely the balance sheet as well as the income statement, profit and loss statement, serve the external customers, statutory purposes, and are more a reflection of your financial numbers out of the general ledger. Okay, in your and you all appreciate the fact that the financial numbers has its own strengths, but when it comes to understanding the efficiencies and margins of each product, right, by various dimensions. So if you want to know what is your margin of at goods issue level, or after you charge the direct cost and conversion cost, etc. I mean, the financial numbers may not give you a better view as good as what a management accounting can help you discover and explore, right? So, an MIS format, this is what typically people call it. An MIS format from a management accounting helps you, analyze, the margins at various stages of your production to sale. So, in this given example that you get to see on the screen, I begin with gross sales revenue. Right? Let's take an example example that my gross sales revenue is 100,000. Okay, I reduce my discounts, various kinds of discounts, trade discount, coupon discount, etc., and then I arrive at net sales revenue. But then the net sales revenue is, let's say, 95,000, because 5,000 is my cost. I reduce it, I get 95,000. From this 95,000, I reduce the cost of my direct cost of my materials as well as conversion, which comes to 50,000. The 50,000, when it's reduced, my margin at this stage is 45,000. Now, from this, I reduce my overhead, admin expenses, etc., salaries, staff salaries, and whatnot, and I arrive at my contribution margin two. I remove this 10,000 from this 45,000. The numbers in this green represents the margin that I have made, and I arrive at 35,000. Subsequently, I remove my sales and distribution cost. Then I remove my non-operating income and expenses, and then I arrive at 25,000, which is my PBDIT, which is profit before dividend, interest, and taxes. PBDIT is best dealt by the finance, but from a management perspective, this is the best representation. Now, very, very often, this is a typical need that the management would like to understand which of their line of businesses has gives them better profit, better margins. Let's say a company is dealing with cosmetics, as well as it is dealing with personal care and men's grooming, and also digital appliances, right? You have four line of businesses. Now, how do I know what is my margin generated by each of these line of businesses? Now, that is where management accounting comes to help. Now, if I want to understand what is the profit and margin generated by various product groups, in a steel industry, Bloom, Bliss, and you have various coils, slabs, etc. Which of these product groups have given me better yield, or where do I have inefficiencies? Now, that is again where management accounting comes with stronger capability to help find answers to your questions. Now, if you want to understand, your profit by state, which of the state or region is helping contributing the most or the least to the profit that you are making? Which of these product subcategories, for example, you are dealing with leather products, cloth products, plastics, electronics, etc., which of them are contributing to your profit, which is hurting your margins? Now, again, that is where this MIS format or the management accounting comes into great help. So this is achieved by something called COPA, profitability analysis. It is also referred as COPA in SAP by all SAP practitioners. Now, why did I bring this reference? We are going to make use of it, and we'll also be covering this as part of our training curricula. Now, one thing that you need to remember is that in SAP, to generate financial statements, you have just four dimensions. The first one is legal entity or company code. The second one is your business area. There are different schools of thought. Some say use it, some say you don't use it. SAP also has two different recommendations. The third one is profit center. And fourth one is your segment. Using these four dimensions, you can generate a balance sheet and income statement. But if you want to know profit based on your leather products or SKUs that makes up your cloth products, etc., or you want to know your profit by what you call men's wear, women's wear, kids wear, etc., then you tend to use the profitability analysis. Fair enough. So let's now move into the next slide. Okay. What do I have here for you? I have an example of how do you arrive at the planned rate of an activity, planned cost, or I would rather prefer it call it as planned rate of activity. This is usually done during the end of the year for the subsequent year. So if I am in 2024, I should have done my annual operating plan around November, December of 2023. The businesses make this annual operating plan, then they break it down, top down distribution, they break it down to plant level, cost center level, department level, etc. And then for our purposes of product costing, we take the value denomination, the amount, and then we go to the production department, production planning department, and we also understand what is the quantity consumption, how many hours of labor has been expended during the previous year. Okay, how many hours of power consumption has happened, how many liters of fuel has been utilized last year. And based on our past estimates and by loading other aspects, taking into considerations, we arrive at a planned rate of the activity. Here I am computing the cost of labor. Let's say last year I have spent, or last year I have spent 80,000 rupees or dollars per for labor for 800 hours of labor. I have five workers working in my production line for 8 hours and 20 working days. So I get it 800 hours. Now it can change based on the skill, etc., at different work center level. But for this example, 80,000 divided by 800 hours gives me the planned rate as 100 rupees per hour. Now I move to arriving the preliminary cost estimate of the finished product that we are trying to make. There's a small error here. Please read this as 1112. It's a small arithmetic number which I should have fixed it. Okay. So to make the finished product, one finished product, I need three units of raw material one. I need 2 units of raw material 2, and again 1 unit of packaging material 3. So this is what is referred as bill of material. Converse of the statement is that a bill of material comprises the units of subcomponents that are required to manufacture 1 unit of production. It can be 1 unit of production or one lot size of production, for typically small screws, nuts, and etc. You may not want to manufacture 1 unit. It is usually manufactured in lots of thousands or 10,000s, etc. Right. So either to manufacture 1 unit of output, it could be semi-finished good or it could be finished good, or one lot size of output. What that comes from the bill of material. Now you see on the left side, I have labor cost, machine power. Okay, these are applied using routing. Okay. Now in my previous slide, I have shown you how I have computed the per unit price per unit in, right. I have here 100 was 80,000 by 800 hours. I got 100. And to manufacture one finished good, I need 5 hours. So 5 into 100, I have got 500. Similarly, 60 into 5, I have 300. 60 is the cost per hour to utilize the machine. It could be depreciation cost, it could be various other costs required to operate this machine per hour. I need to spend 60 rupees. So 5 hours, that comes to 300. Then power cost, it is 5 rupees per unit, and I need to expend 20 units to produce 1 unit. So I make 100. All these make up 800. So 120 plus 800 gives me 920. On top of it, I loaded 10% as overheads, which represents my, as I said, administrative expenses, staff salaries, etc. And it comes to 92. So the total of all these should make 1112. I'm sorry for this small arithmetic error. Okay, so it's 1112. So now the next thing is how those were your estimate, those were your preliminary estimate that you have arrived at. Okay, 1112. Now we go to the actual price calculation. The actual price calculation you get to know during the month end after booking all your expenses. Now let's say instead of 80,000 you have to spend 96,000 as labor cost for the same 800 hours. Now your cost doesn't remain 100 anymore. So the cost that you get to know is 120. During the month end, we perform an activity using which we determine the actual rate per activity, per unit of activity. Let's say per hour, per liter, per unit of power consumption, whatever might be your unit of denomination, you arrive at a per hour rate. Then there is machine cost, then there is power cost 120, 75, and 6. Fair enough. Now let's apply it to what we have produced, that one single unit. Okay. The standard cost that I have already shown you, it is 1112. Fair enough. Then let's apply the actual cost. Now you consume 3 units, but your revised price, the material price is 22. There has been certain price increase. That which was 20 is now 22. That which was 15, raw material 2, is now costing you 18. There is some reduction in the packing material. It used to cost you 30. That was your plan previously. This year there is a reduction. It's 25. So the cost, instead of 120, the material total material consumption comes to 145. Right? Subsequently, the activity cost has been revised. It's no longer 100, it's 120. Machine cost is not 60, it is 75. Then your per unit rate is not 5 anymore, it's 6. When you apply, you come to 1485. Now, accordingly, your 10% overhead changes to 145 plus 1485, and you add 163 on top of it. So you come to 1793. Let me do the quick math. I think there's a small error here. 1485 plus 145. Yeah, it is 1630. On 1630, I apply a 10%, so 163. That comes to 1793. So my preliminary cost was 1112. My actual cost is 1793. Now during the month end, okay, when I do the actual costing, right? Then when I do my variance calculation, I get to know that 481 is my variance, which has to be loaded onto the product. Now, product costing helps you understand, right? The breakup of these variances. Why did I get this variance? Who is the culprit behind the increase of 481? Is it material? If it is material, which material is it which hit my margins, etc.? Fair enough. So that is something we get through variance as part of settlement. Then during as part of the subsequent costing ML run, we take these variances and load it back to the inventory. Now we are going to understand a completely different aspect. Okay, I'm going to merge all of these things subsequently in understand, help me making you understand the product costing. Give me a second. What is inventorization of costs? Okay, impact on P&L and balance sheet. Let's look into that. Okay. Let's assume you produced 10 units of your finished goods and sold 5 of them, and sale price of each unit is at rupees 3000. This is also called inventory method of accounting. So let's go into that. Okay. In using the same heuristics from our previous example, right? I have bought some 1000 units of raw material one at 22, so it comes to 22,000. Raw material 2 at 1000 units at 18, so it comes to 18,000. Then packing material, I bought 1000 units at each one at 25, and it comes to 25,000. I have not paid by cash, so it reflects as my trade payables. I have the income statement, expense, income, balance sheet. Sorry, this should be liabilities and assets. Give me a second. You have your liability and your assets. You usually do not have quantity. I have just added this column so that I can help you understand it in some, for the betterment of our understanding. Just to simplify, I have added this column. Neither would you see separate GL account line items for each raw materials that would be maintained in the material ledger. You will only see one single line item for raw material inventory, then SFG inventory, you'll have a separate line, and finished goods, you'll have a separate line. I have broken it down into multiple lines to make it easier for you to understand. Please do not misunderstand the outcome, not the outcome, misunderstand this particular representation. Let me now um, make it a full screen. Okay. Now I issue 3 units of raw material one, 3 units of RM2, and 1 unit of packing material uh, for producing this 1 unit. So my inventory from balance sheet reduces and I hit my P&L as an consumption. So my consumption of RM1, consumption of RM2 and packing material is 66 plus 54, 120 plus 25 is 145. 145 is what tallies back. This is the 145. So when I produce 1 unit, I tend to consume this many amount of material. Fair enough. Now let's go to the next screen. During the month end, I get the cost of all the activities, right? So I get labor, machine, power. Labor is 840, machine is 525, and then power is 120. So I get the cost of activity cost here. Then I have my indirect cost coming from salaries, etc. That comes to 163. Now, for all these things, I have provision for expense. If I pay, it would hit my cash or bank. Otherwise, it would be provision for expense. Then we have, let's say I have sold 5 units. The 5 units comes to 15,000. Each unit I am selling at 3,000 for this scenario. So I have 5 units, that is 15,000. So 15,000 is my revenue, and my cost has come to 17,930, and I have made a loss of 2,930 as per whatever you see on the screen, right? But whereas I have sold each unit at 3,000. My cost of manufacturing each unit is 1793. So I should have in fact made a profit of 1,207. But why is my P&L showing a loss? Now your P&L is showing a loss because on the expense side you have booked expenses to the for all the 10 units of production, whereas you have booked revenue only for the actual sales of 5 units. So your expense is overshot by the expenses of the additional 5 units which is not yet sold. Now where is the best way to park those 5 units which is not sold? You need to park those in the inventory of finished goods on the balance sheet under current assets. Let's see how it reflects. Now, if cost of manufacturing is 1793 per unit and you sell at rupees 3,000, you tend to make a profit, but here it shows loss, which is what I explained you. And what I do is I take all of these cost of manufacturing and I inventorize them. Yeah, I tend to inventorize the costs. Let me look at the next screen. So I have 15,000 here. I have my finished goods. Finished goods were 17,930. Out of the 17,930, I have sold 5 units. So the 5 units is what I hit into my P&L as COGS. Cost of goods sold is 8,965. All right. The remaining 8,965 worth of 5 units remains on my balance sheet. Now, if you look at it, we have 15,000 here. Oh, sorry, this should have been 15,000. And then I have made a profit of 6,035. So I had to go back onto the PPT and I have changed these numbers. The total should be 15,000 here. For 15,000, I have made a profit of 6,035, which is the actual profit. And rest of the goods which is unsold is currently parked in the under current assets in finished goods. Let me go to the next slide. The next slide now we are going to talk about the standard price versus moving average price. Okay. So far we have learned what is product costing. Fair enough. Then we have learned about inventorization of costs. If you do not inventorize your unsold stock and you keep it on your P&L, we saw that how he hits your loss. It makes a loss for you. And now you have to inventorize and only reflect on P&L those costs which has yielded your revenue as per the matching concept. Fair enough. Now we'll get into the third concept of moving average price versus the standard price. A very, very important aspect. Now in SAP, we have something called price determination, and then we have something called price control. In price control, you have moving average price and then the standard price, right? And then let's say I'll just quickly explain you the difference between both of them. In the moving average price, with each transaction, you reflect the inventory, the whatever inflation in subsequent lot you have got. For example, you have bought 3 units at $2 each. That makes six. Subsequently, you buy 5 units at $5 each. Then it becomes 25 of the same raw material. Now your total cost is 25 plus 6, 31. Whereas your material number of units of material is 3 plus 5, that is 8. So you divide 31 by 8, that is what your moving average price is. So I have shown you in great detail this example, how it reflects on your P&L, etc. Now, price determination is transaction based or single or multi-level. This will be discussed in subsequent classes because the concept is slightly complex at this point of time. We are going to only cover and understand the impact of both these things. Let me go to the next one. Here I have moving average price. The first thing that you see here is I purchased on 1st Jan a material purchased on credit 5 units at 5,000, which comes to 25,000. Broadcasting is all numbers, so it's a number game. So those you who enjoy arithmetics, you will be really happy to work on this. So 5 units, I bought it at 5,000, so it is 25,000. So my moving average price is total amount, that is 25,000 inventory value divided by the stock is my moving average price. Subsequently, I sold 1 unit from this at 8,000, but from an inventory perspective, the 5,000 is reduced. My stock value is 20,000. 20,000 divided by 4 gives me 5,000, right? Subsequently, I bought 5 units. This time, the cost of the same material comes to me at 6,000. 6,000 into 5 is 30,000. 30,000. So my total stock value in inventory is 20,000 plus 30,000, which is 50,000. And total inventory stock is 9 units. So 50,000 divided by 9 comes to 5,555. Now, out of this 555, I again sell one material again at 8,000. Fair enough. So my stock reduced to 8. Okay. But my cost of inventory is 5,555. When I reduce 5,555, I get 44,445. And my moving average price is 5,555. Now, these are all numbers. But let's look at what is the impact on the P&L. Now, my inventory value at the end of the month. So I have let's look at the revenue. Revenue, I sold 2 units, 1 unit at 8,000, second unit at 8,000. Fair enough. The cost of goods sold, sorry, I had to make a quick correction. This was shown as 5,000. So my first unit which I sold goes at 5,000, right? On 5th Jan, when I have sold my first unit, it has gone in as 5,000. But subsequently, my moving average price has been revised as 5,555. So the second unit has gone in as 5,555. Total revenue stands at 16,000. Total expenses is 10,555. My profit as per the moving average price is 5,445. Let's say at the close of the month or year, I move it to retained earnings. So I have 5,445. My balance sheet tallies. Now this is as per moving average price. In moving average price, the inventory is loaded with the price differences that comes with each purchase at each transaction. Now this is what we achieve using the moving average price, which I have shown you in the previous screen, which is it is transaction based. The price is determined by with each transaction and then based on moving average price. Now let's look at standard costing. Now in the standard costing, what happens is that you purchase the first lot at 5,000 each, so it comes to 25,000. Then you sold one unit, and that one unit is consumed here. In this example, as you can see, I have bought 5 units and which costed me 25,000. I issued the first unit, and so my inventory reduces by 5,000, and my standard price is 5,000. So I have hit here my COGS with 5,000. Subsequently, I bought each unit at 6,000. If you look here, I have bought each unit at 6,000. So my total cost comes to 30,000, right? But in the inventory, I still maintain it as just 5,000. So it is 5,000 into your 6, it should be 30,000 is what I load. 30,000 I add it to the 20,000. So my cumulative inventory is 50,000, right? What about the remaining 5,000? Because I am just loading here 50,000. So I take that value to an account called price difference account. Price difference account is 5,000. As you can see, the price difference account has come to 5,000. Now, when I sell 6 units again, I take the COGS as 30,000. Each unit is at 30,000. Now, this price variance is on 5 units. So the price variance, so from the first lot, I have consumed 5 units because I had 5 units in the first lot. In lot 2, I have bought 5 units. So let's say I follow the FIFO principle. So total stock I sold is 7 units. So 7 units, the first unit comes from lot 1. In the 6, the remaining 4 has come. So another 2 units has been consumed from lot 2, which I have bought on 10th Jan. All right. On 10th Jan. And then on 5th Jan, whatever I have sold here, the total revenue comes to 54,000. In the 54,000, 5,000 plus 30,000 is your 35,000. So I still have a profit, a price difference of 3,000 hitting my P&L, which relates to 3 unsold stock. This is before you run your CKMLCP run. This is not the right profit here. The 14,000 is not the right profit. Why it is not the right profit? Because you have taken the entire price variance of 5,000 to your P&L, but sold only 2 units out of this lot. So the price variance of 3 units should go back and get charged to your inventory. So what I do is that once you run the CKMLCP, the run, right, all the price variances goes back and hits your inventory. So let me go to the next screen. So you can see the price differences on 3 units goes back and gets added to the inventory. In previous screen, you would have seen it was 15,000. Now, in the next screen, you can see it is 18,000 because from the second lot where the increased price, we have sold only 2 units. That 2 units we are retaining in the P&L, and my profit accordingly has gone to the 17,000, and my inventory value is now appreciated with this price difference during the month end. Now, these are all features which are already automated in the costing processes. Now, as part of your product costing, today you have understood what is product costing, what is inventorization of cost, what is the impact of moving average price, what is the impact of standard price. As I have shown you during the beginning of the session, we will be covering in great detail the entire SAP product costing with all of the advanced scenarios, going into great length into each of these, why we will be doing each functionality. So thank you very much. If should you have any more queries, you can reach out to us here on the given number. Thank you.